Thing on my mind, gotta hustle and grind. Financial literacy always on my mind. I'm stacking knowledge, no time to waste. Gotta invest smart, gotta keep up the pace. I'm reading books, learning all the tricks, studying the market, making calculated picks.
What's good, everybody? Good grief, man! I'm playing with stuff over here, and I don't know what's going on. So let's see here. We gotta fix that too. Bam. Hold on. Let's see. Jump into the settings. Okay, cool. Yeah, we did that right. Okay. Back at it again with another bag talk. We're talking about this episode's going to be specifically about another addition to the building your financial structure. We're actually starting at the beginning. We started at the end, but since we did a video that kind of gave a quick overrun of the next two steps, I try to keep this as simple as possible. So for me, my financial structure has 3 layers. And just for reiteration of those 3 layers, obviously last week we went over the flywheel, which is ways that your portfolio can become self-perpetuating by utilizing and repaying loans and debt. You're able to use debt. Basically what the strategy is of the company formerly known as MicroStrategy, what Michael Saylor is doing. And at the end of the financial structure, that's the mechanism that allows it to become self-perpetuating, which means that technically your job could just be a financial strategist at that point. Like all you're doing is manipulating money. You're a money magi, you're a money magician. And being a Bitcoin standard believer, philosophizer, utilizer over here, all of my stuff comes from that angle. You can apply that to other things. I just don't know that there's anything else in existence currently that has the growth that grows fast enough for the arbitrage to be what it needs to be in order for this strategy to work. So that's just my 2 cents on it and my take. Today, we're talking about the base layer, which is the collateral layer. We're going to jump right into that. Before we do, I want to make sure you guys hit the like, share, and subscribe on your way in. Hopefully, you follow the instructions on the little quick intro there. I've still got some work to do on that. We got to do some updates around here, some sprucing up. We got some more lighting. I got a little bit more lighting, so it's a little clearer. And yeah. So let's see here. Actually, yeah, we are. Okay, so we're jumping in, and the reason I call this the collateral layer is because I do not buy stocks with the intent of ever selling. I buy stocks with the intent of holding on to them and borrowing against them. I'm acquiring collateral, which means that I am building a margin pool that grows. So this is going to be my growth stuff, my long-term holdings. Granted, in my long-term holdings, only a handful, actually not even a handful, 2 of the positions as it sits right now are collateralizable, but that's just the way that it is. So we're going to talk about a couple of those positions and that you see regularly when I do my financial updates. There's updates on these said positions. And we're going to go ahead and dive into the weeds. This is specifically over building your collateral layer. And we're going to go ahead and jump right on into it. So the first thing we got to do is lay down the foundation here. Obviously, this is based on a Bitcoin standard. You want collateral that's going to grow. Hopefully, you have exponential growth on it, because if you're using it to borrow against, you obviously want it forever going up. I do believe in paying back loans. I pay back loans. The collateral layer is the base layer. This is the slowest moving money that I have in my possession at any given time, in the sense that it doesn't produce income. Generally speaking, though, we are looking for it to outgrow Bitcoin. That is the current CAGR, which I do my basis against. And it's either that or it's stabilized and pulling income. So there's 3 layers. There's the collateral layer, which is the slowest moving layer. You have your income layer, which produces income. That's how you pay back the loans. And then you have your flywheel layer, which are the tools that you have at your disposal, collateral that you are keeping places to be able to borrow against, which includes your any form of credit that you have. That's the reason we build good credit. I believe in having good credit. It's kind of important, especially if you're running a strategy such as this. And yeah, so working on the collateral layer, we are looking at things like Bitcoin as a basis. Now that's going to be a base one because now we can collateralize Bitcoin. We have a few platforms that we can use from the flywheel layer. When we do the flywheel layer, I will update that because we have a couple of options now. One of my oldies but goodies came back to the United States. So there is that. But STRC, which is a big one, obviously sitting at $99.75 right now. So if we're below $100 on payday, obviously they've been buying some Bitcoin. Brought the price down a little bit. Anything sub 100 is a smash buy, an easy smash buy for me. So that's pretty cool. We will be making that adjustment because I do owe myself 1 share from our payday that we just had. And it was 100 that day, so we did not deploy into STRC. I actually completely forgot about it. But since we're sitting here and we're looking at it, I'm like, yeah, below 100, if we open up on Monday at below 100, I'll go ahead and scoop up that share because that's what we do. Under 100, smash buy. One of the important things about this, though, is this not only pays 11.5%, which provides some income for us, it also gives you a little bit, actually, it's not even a little bit, it's a good amount of margin ability because you only have to keep 30% that you have to keep in the portfolio, which means that like as you buy this, once you get over $2,000, now that's a caveat for the collateral layer, is your portfolio has to be above $2,000. Once you get above $2,000, they generally allow you to start borrowing against your portfolio in and of itself. There are 2 ways that works. You can borrow against your portfolio to buy more stock, which they give you a lot more leeway on. You get a lot more margin for that. But the other thing that you can do is you can take cash out of your portfolio without having to sell your stocks. So you just issue a loan, which means that you don't incur a taxable event. You just get some cash. Then they charge you margin, which is generally anywhere between 5 and I'd say about 13%. If it's over 13%, I would recommend going to a different brokerage unless interest rates are just ridiculous. But as it sits right now, that's the leeway that you're given. I generally use the margin specifically to pull out to pay bills. And then after I have that margin balance, I utilize the income layer to repay the margin loan. Also, it allows me, while I have a margin loan active, when I get paid, it pays down the margin a little bit and I can just utilize the margin again to then continue buying stock. So every time I get paid, instead of just paying down the margin loan, I can redeploy those funds from my W-2 immediately as soon as it hits the account and the market opens, which I love. It's one of the perks of being fully invested is I am constantly growing that income layer. Now that we're deleveraging a little bit, or better yet, de-risking, we're adding to the margin pool. So that margin pool is expanding bit by bit every 2 weeks, which is pretty awesome. And our long-term holdings portfolio has actually hit a point to where now we have the ability to front ourselves a little bit over there and tap into the margin over in that portfolio because we're sitting well past $2,000 at almost $4,000. But STRC is a foundation. It's obviously my cash reserve, my dry powder. And I generally don't deploy that until I have over $1,000 sitting in that specific position and I have an opportunity. As it sits right now, we are under $1,000. We are in an opportunity window, but we're not quite there yet. So STRC being some of the slowest, what I consider a cash position, my high yield checking of 11.5%. If your checking is not getting 11.5%, then I don't know what you're doing with your cash. And from my perspective, now, obviously, this doesn't sit flat at $100. It's not guaranteed. It dips below $100. When it does, I buy more. That's me personally, because it's going to get back up to $100, or they're going to keep raising the interest rate, and we're going to be adding to that pool of money every single month. That works for me. The next thing we got, obviously, is our amplified Bitcoin exposure. Now, as it sits currently, I've only got one stock that I can buy to add to that position with the ability to outgrow Bitcoin. And that's MSTR. And the reason being is MSTR specifically gives you margin. So I get that same 30% treatment, that standard marginability. I get access to 70% of the capital. Now, this is a fluctuating capital, but as it grows, so does the capital pool, which is pretty nice. It is right now on par, right about par with the NAV. It's almost like a 1-to-1 for the Bitcoin that they hold. So that's not bad. I've got a few other amplified Bitcoin exposure positions that I am focused on currently, which has got me buying this a little bit slower than I normally would, because it's just a better value for the same amplified Bitcoin exposure. But the drawback of that is I do not get the ability to borrow against it, which sucks. So for right now, MSTR, we're getting at least a share at these right prices every 2 weeks, which is great. And we're looking at getting to our 10 shares. And I keep finding these new opportunities for amplified Bitcoin exposure, and everything else besides MSTR right now, as it sits, pretty much is undervalued based against their Bitcoin holdings. So these Bitcoin treasuries are holding Bitcoin and they're selling for under the price of the Bitcoin that they hold. To me, that's an easy smash buy. So we're kind of rushing some other positions and putting our focus there. But I am making sure to get one share added to this pool every couple of weeks. And we're getting whole shares because I'm buying it over in the big boy fund. So we can't buy partial shares. But as we start spinning up the Robinhood account, we will see what this looks like spinning up partial shares on a few positions, which I'm kind of excited about. It's one of the things I like about Robinhood is like I can actually parse out and purchase positions based on the allocation that they're supposed to get, because Robinhood does allow partial shares. Charles Schwab does not. Charles Schwab gives me my dividends during the day so that I can deploy them immediately if I need to. Pretty nice. Robinhood doesn't do that. You get them well after hours. But this is the other position that we are going to have we're going to be talking about, because as we get to certain amounts, so like once we get to 10 MSTR, actually I guess 11, I will move 10 shares over into my primary income to add to the margin pool, because that income portfolio is not going to just be income positions, I don't think. I mean, we'll have to see, considering I can pull cash out of my long-term holds and just pay it back. Like, I can do that too. I'm not 100% sure how I want to do that. I might keep them separate. We will see. But this tips the way that we generally look at investments on its head, because then you're going, okay, so you want, and in all honesty, with something like this, you could almost, like I said, you can do this with whatever your thesis is, but like long dated, boring stocks that are just going to be around forever, at least the whole time that you're alive. That's what you want to build your collateralization layer out of. For me personally, since I'm on a Bitcoin standard, I want everything touching Bitcoin. And while MicroStrategy is highly volatile, the upside on it during the growth periods are amazing for a growth stock. You could also use hold on, let me pull that up. You could also use something like IBIT is also something that you could use if you're going fully collateralized. Simplified Bitcoin exposure. This is leverageable. So you can do that. Also, you can get the IBIT share. You can do shares of IBIT, and then you have that Bitcoin exposure. It tracks Bitcoin. I personally like holding actual Bitcoin just because we have platforms where we can leverage it now, which is same difference for me as potato. I prefer to have an active Bitcoin allocation because if stuff goes bad, I can put it back in cold storage with the rest of my Bitcoin and, do what I got to do. Also, it keeps me in pure play Bitcoin, which makes me feel a lot better when it comes to Bitcoin. Because I've been in it so long, I believe that that's the best way to do it. Because obviously, anything you're doing on the traditional finance side is subject to you were at someone else's pleasure to use their stuff. And while you're using their stuff, that's going to be up to them. Like you can get deplatformed. They can lock your funds up. I don't like that. That's the reason I hold straight up Bitcoin in cold storage. That's the reason we're scrambling to get an active allocation, because my goal is to get that additional 0.25, which is another important metric. Because a lot of you, it's not going to be possible for you to hit a whole Bitcoin. It's just not going to be feasible. The price keeps going up. It's running away from you. It's just like if you're trying to buy a house cash. Price is just going to keep running away from you. You can't have anything. The world's a not fair place, and it is what it is. But I think 0.2, 0.25 should be attainable. Like that's an attainable target. And so I'm trying to get an additional 0.25 or at least 0.2 that's on exchange active specifically for me to borrow against, and then have all the Bitcoin after that stay in cold storage and build up my cold storage cash with that. And we'll be going over my strategy for that on the income layer. Well, I guess when we go over the income layer, that's going to be a little bit of a different conversation, and we'll just be going over bringing money in. But I've gone over multiple times the way that I borrow money. Like when I borrow, I take 10% of it. It goes into Bitcoin or Bitcoin amplified Bitcoin exposure, depending on where we're at, where we're sitting with stuff. And as we do that, once we start collateralizing against and leveraging against our Bitcoin, those count as loans as well. So now you're borrowing against Bitcoin, buying a little Bitcoin when you're buying, as well as all the other things I'm doing. Because when I pull margin, I'm taking 10% of that margin pool, and I consider that a loan. That's all money that I borrow from myself or from my flywheels. 10% goes into amplified Bitcoin exposure or purchasing Bitcoin. So in doing that, we're putting ourselves in position to be able to continually be accumulating Bitcoin while keeping these levers in motion. Now, obviously, we're doing our last debt cycle, which I'm actually getting ready to do probably today or tomorrow after this recording. And we're putting those mechanisms in position to get ourselves to where we can start chunking down this debt again, because the debt is going against us in a direction that I don't like. And it's just because I am so focused on staying fully invested. I just refuse to not be fully invested. And with the income fluctuations being what they are, there's wins and losses on that. And now that I've gone into a hyper accumulation zone for Bitcoin, I've altered my income portfolio a lot, and we put positions in there where now we're actually managing those positions, and we're just building now for that upswing. And when it's time to feast, we're looking at hopefully being in position to where we're getting plenty of income to speed run this debt. But one of the things you don't want to do, especially when you're managing lots of debt, which we're sitting at around $30,000 again. You don't want to be catching finances charges on that. So like we're moving stuff into position to where we're not getting hit with finance charges. And then also upping the amount that we're paying because we're dipping into that margin. I'm like, well, if we're going to run the margin, let's run the margin and get this stuff filtered on out. So we're really putting in a lot of work towards getting those positions where they need to be. And this last debt cycle, we're going to get a little bit of a cash infusion off that. We're going to get a little bit of straight up Bitcoin off that. And then we're also going to get a little bit of amplified Bitcoin exposure off of that. We're going to be hitting both ends and kicking up a little cash infusion into the income portfolio to kind of see what we can get, see if we can get some stuff popping off. And I'm excited about it. So that's where we're going to be sitting with that. We're going to end it on that note. The collateral layer is pivotal and strategic. And when you're building out your finances, those are things that you want to look at because you don't want to be in a bunch of positions that you can't leverage against if you're trying to run this strategy. You have to have things that you can collateralize against. And actually, you know what? We should probably do a little quick breakdown on how to check that, because that's pretty important. That'll be an important. We're staying focused, but I want you guys to leave with some form of tangible. So this will be it. Let's go ahead and jump in here. And so we'll go take a look at MSTR. Okay, I'm going to add this to the screen. This is inside Charles Schwab. So this is if you pull it up on the website, it's a little bit different. Let's see here. Earnings. Pearson ratios. That's the state. Those are the technicals. And they have preferreds. So what we want to look at is the margin ability of it. Let's see. Where is the profile? That's equity research tool watch list. There we go. Short interest, stay connected. Oh, there we go. Nope, that's not what we're looking for. Okay, so go back here. All right, so this is a learning experience because I have no idea where this is on the website. So what we're going to do is let's go take a look and see if I can find it in an easier fashion. Okay, so here's on Robinhood. Let's see if we can find it on here. There we go. Oh, hold on. Short raise. Okay, let me see if I can find another one on Robinhood. price. Where is? Huh, that's crazy. It does not. That is so wild that they make it so hard to look at this on. Well, so. Oh, you know what? That's what it is. So the short maintenance ratio is the amount that they'll let you pull. The minimum you have to have, you need to have in position while borrowing on margin. So the short maintenance ratio is what it costs, what you can get borrowing to get to cash. So this actually, short maintenance is 30%. So this is what I look at when you're looking at a stock to see if you can borrow against it, because there are certain ones where it says 100%. And let me give you an example of that. Because I know you can't borrow against Granite Share stuff. Oh, they will let you borrow against Granite Shares on Robinhood. Robinhood's winning because Charles Schwab does not let you borrow against Granite Shares at all. Hold on a second. Let me take a look at something real quick. So see, ASST, you can't borrow against that, period. Short maintenance is 150%. So this is one that you can't borrow against. They will give you nothing. So having this as part of your collateral layer, this is not good for collateral layer. Unless you're only using it to buy stocks, because then you can get a little bit off the position. But borrowing against this to get cash out, you're not going to be able to get cash out of a position like this. So that's the tangible, is like that's what you're looking for. I'm sorry it's so hard to pull this stuff up online. It's a lot easier to do on the mobile apps, because like Charles Schwab, it's super easy to find it. I don't understand why when it's the website it's darn near impossible. But Robinhood, a little bit easier, but this is also easier information to find inside the mobile app because they're built for mobile apping. So it is what it is. But that's what something that I wanted to show you. So definitely something to keep in mind when you're looking at getting started setting up your financial structure. The collateral layer is very important, and thinking ahead. It's very boring when you're having to allocate a portion of your income towards something that doesn't produce income, but it's, as you're building, if you're building from zero, it's important to have that collateral layer built in and to be stacking those positions as well, because once you hit $2,000 and can borrow, you'll have something that's kind of not as variable as the rest of your portfolio, most likely. You can also use ETFs that are based on the S&P 500. That would be a decent collateral layer also. It's just not going to grow in the fashion that I'm looking for. It's not going to beat my personal CAGR, but you know what? If your CAGR's the S&P 500, which is a lot of people's are, that can be your collateral layer, because at that point you're basically getting that. I would still have STRC, because that, from an income perspective, is going to give you collateral plus income. Like, I honestly, if S&P 500 was my hurdle rate, I would just hold all. I would have the collateral layer just be STRC, so that way you can at least be stacking in an income fashion on top of whatever income you build in the income layer, which we will be talking about next week. So until next week, it's your boy Reckless Ray Dinero. Don't forget to like, share, and subscribe. This has been another Bag Talk episode on the collateral layer of your financial structure. The channel is Future Financial Strategies. And I am out. Peace.
Money on my mind, yeah. Focus, got no time for games, nah. I don't play, man, I'm all about that financial literacy. Investing in my future, building generational wealth. Dollar bills, they be calling my name, but I ain't chasing fame, I'm chasing change. Learn the game, now I'm playing it smart. Putting my money to work, it's an art. I'm stacking paper, building my own empire. No more living check to check, I'm getting higher. Investing in stocks, real estate, and more. Gotta secure the bag, that's what I came for.